Maverick of Wall Street. Maverick of Wall Street makes some pretty dang big predictions, and about this 12-minute segment that I want to watch with you guys and kind of give my perspective on here on where the market's headed, where CPI is headed, and on many other various things that are very important for kind of how the market's going to move moving forward. Okay. Now, before we get into his opinion and kind of my opinion versus his opinion, things like that, let me just address this, right? Because I understand, like, obviously, I lean very bullish, right? Somebody like Maverick leans very bearish. If you watch his content, you know that, right? Now, you might say, why would I even watch, bearish views like that? If there's one thing I know about myself, I can be too confident. I can be too bullish many times. And so I love to kind of watch somebody like Maverick of Wall Street, who I actually think is very knowledgeable, and just to kind of I guess you say bring me down a little bit, or just kind of leave me a little more even keel. And so that's kind of why I look at his videos, and I like to hear bearish perspectives and kind of how would somebody look at this from a negative standpoint? And then I can kind of make my judgments based upon, kind of what I hear there, and kind of do I believe this is reality? Do I believe, he's stretching, he's reaching for things and things like that? So there aren't a lot of very intelligent bears. Let's just call it that. And to be bearish, honestly, it's a very hard thing because you're going against the whole system. You're going against everything. And so it doesn't pay to be a bear. I'll put it that way. It doesn't pay to be a bear. And, you'll pay a lot better to be a bull, okay? There's a reason there's no bears that are the richest people in the world. Think about that for a moment, okay? But, nonetheless, obviously Maverick's getting a ton of hate right now. The market has been pretty much straight up for 9 months now at this point in time, which if you're bearish, it's going to make you look really bad, right? I went through that hate storm last year, right, 2022. Every single time I'd buy the dip, I got lower, like nothing could work out, man. Every stock was down and down and down. And so obviously somebody like myself got a lot of hate last year. I'm getting a lot of love this year, right? Last year he got a ton of love. Now he's getting hate, and that's just kind of the way it is in the market. So appreciate you guys joining me as always. Thanks so much for being here, folks. Thanks for being subscribed. Looking forward to getting into this one, and let's get into it.
So I got a good one for you tonight. Let's begin with this. Today we got the CPI reading for the month of June, and it was pretty much plain vanilla. The cooks gave us just a little touch below expectations. The month-on-month CPI, the expectations were 0.3%. We got 0.2%. Same goes for the core CPI month-on-month. CPI year-on-year, the expectations were 3.1. We got 3%. Core CPI expectations 5%. We got 4.8%. We know that the majority of the inflation problem comes from the services sector this time around, unlike last year, where the majority of the inflation problem came from goods and energy prices. So when we look at the so-called super core CPI, which is basically services minus housing and energy, because, housing and energy are not really that important, the reading is 4% year on year. If we look at Jerome Powell's favorite indicator, which is core services X housing, because again, housing is not really that important, it is down at 4%. But a reminder, all of these readings are being suppressed because of the base impacts. The base impacts already expired now. In the next reading, we have 0 base impacts, which makes the next reading really, really interesting. But here are the details. And my favorite indicator right now, because the majority of inflation is in services, is actually services less energy services. If we take that reading, it's up by 6.2% year on year. So the base impacts aside, we haven't done any real progress in defeating services inflation. And unfortunately, according to...
So far, you can point out this and that. The bulls do it on the same side. Somebody like a Tom Lee would point out, well, this metric right here, look at how low this is. This is what you call grasping for straws, when you're basically looking for, whatever can try to get your case to be right. And bulls do it, bears do it. They point out this little thing over here. Well, what about this number? And at the end of the day, if you're grasping, it's not usually a good
beloved media propagandists and analysts, they've already declared victory. Inflation is over. It's done. It's dead. That's it. Goodbye. But what they're not telling you is the majority of the drop that we got is coming from base impacts, and we haven't done real progress when it comes to services inflation. Here's the commentary from economist Mohamed Al-Arian. Take a look.
Right. So we've entered a nice period for the CPI headline inflation prints. I think we'll get around 3% today. I think it's going to be well behaved on an annual basis because of the base effects. But me and many, many others are going to be looking not just at core, not just at services, but asking the question, can you maintain goods disinflation? That's what has gotten us down here, particularly energy, while also starting to see services disinflation. That is the big question. I worry a little bit that people are jumping to the conclusion that goods disinflation will immediately translate into service disinflation. That's not what we're seeing in the rest of the world. So we just got to keep a really close eye on that.
So in a nutshell, Larian says that don't assume that the disinflation that we've seen in goods will somehow translate into disinflation in services just like that. It's going to take more aggression by the
For
Fed.
anybody a little newer to the markets, if you're wondering like goods versus, services and things like that, think about goods as like you order something on Amazon, like a physical item or something like that. Services, think about like going to get a massage or get your house cleaned or, have landscaping done, things like that.
To see a response in services inflation. But what I would tell Mohammed Larian is we got another thing coming for us. We talk about energy inflation as it's a done deal, it's over, it's gone, it's not going to come back. I say you better watch your back. Look at the month-on-month readings in energy categories. We've been seeing a disinflation process. The month-on-month readings were negative, going all the way back since the beginning of the year. Yet in the latest reading, we see the month-on-month disinflation process in energy categories actually stopping and turning positive. Take, for example, gasoline. The reading was minus 5.6% month-on-month in the May reading. Now it's back to positive 1%. If you look at fuel oil, in the month of May was...
So that's another factor. I mean, gas for pretty much just about everywhere out there is cheaper now than it was last year, right? So we could look at that and say, they must be cooking these numbers the wrong way or something like that. Because I can tell you certainly here in Vegas, gas is cheaper this year in the summertime than it was last year. In Arizona, it was the same exact thing. So I don't know, I guess they're cooking the numbers the wrong way, right?
7.7% month-on-month. Now we're down 0.4% in the month of June. The bottom line is the disinflation process in energy categories is perhaps ending. We're now seeing reinflation in energy categories, which means we could see reinflation in goods again. Transportation costs increase higher, and as a result, we see goods inflation coming back into the picture. And that would be an absolute nightmare scenario. If you look at commodities, the month-to-date performances so far, you can see that the WTI has already scored gains north of 7.5%. We even see the gasoline RBOB gaining about 6% for the month. So we're already seeing the process.
So once again, this is what I call kind of reaching by Mav here, and this is just pure reaching. That's all. That's the best way to describe it. You got to pull these things up a little over a longer period of time, right? Look at a 1 year of GSG, which is just kind of the commodity index in general. It's down 5.7%, right? While the Qs are up 32%. You look at WTI. WTI is down nearly 19% year over year. 19%. We're not talking about small numbers here, right? So, even if we pull up a year to date, WTI hasn't done anything, while the markets have obviously gone risk on. So, you can always cherry pick this and cherry pick that, and look at it in the past week and look at it in, so far month to date and all these things, but you're grasping at that point.
Reinflation in energy commodities, which will be translated into inflation in goods in the next reading of the CPI. Not to mention the fact that we have not done enough progress in services inflation. And on top of that, the base impacts disappear in the next reading. In other words, this could be the bottom reading in the CPI. And look at what it did to the dollar index. This is a monthly chart of the Dixie. It appears to be breaking down. If the Dixie goes down, what do you think will happen to commodities prices? They will appreciate, including energy commodities. And that would be bad news for the prospects of inflation going down.
You could also look at the dollar going down as something that's going to help out corporations' earnings in a massive, substantial way. And we do know the number one thing that drives the stock market over time is earnings, right? So once again, you can look at these things as positive or negative.
News for those who say that we have a soft landing coming in the economy. Bad news for the doves in the Fed and their allies who believe that the job is done. And bad news for the stock market. I shared this in the members video tonight. Since 22, when the Fed started raising rates and tightening the monetary policy, we have an inverse relationship between the Qs and the XLE, the oil ETF. The point being here is we see the NASDAQ and the biggest names in the stock market appreciating in value when energy stocks lag or trend down. When they trend up, we see the NASDAQ, the Qs going down. In other words, the market rallies based on the prospects of disinflation and the Fed ending the quantitative tightening campaign. But if the dollar crashes and we see reinflation in commodities, specifically energy commodities, then we will...
So before we get into this further, let me explain something I think is very important, because people look at these things like the Qs versus XLE, right, and how energy is doing versus tech stocks and things like that, okay? This is very important. First off, we do know traditional fossil fuels are being eliminated day by day by day, right? We have obviously huge government subsidies that are coming into play. I mean, out here in Vegas, solar panels are everywhere. You try to, drive out of Vegas now and you go through the desert and it's just solar panels on solar panels, right? So we do know that over the next 10, 20 years, especially crude oil, but honestly, even natural gas is going to slowly be eliminated more and more and more, right, by sustainable energy. That's the movement. It is what it is. That's what's going on. You can try to get in the way of it. So the bottom line is oil and gas stocks, the whole category, is becoming less relevant year after year after year. And it's been going on. It's been like that for 10 years now, and it's going to continue on for the next 10, 20 years. Tech stocks. What is even a tech stock nowadays? See, back 20, 30 years ago, you could put stocks in a category and say this is a tech stock. Now everything gets put into a tech stock. Amazon's considered a tech stock, right? Think about their e-commerce business. How much is that really tech related, right? I mean, they got these massive warehouses. People are buying things through an iPad or through their phone or through a computer and things like that. So it gets thrown into a tech stock in the AWS side, right? They also own Whole Foods, which how much tech is Whole Foods. This is just an example of like everything gets thrown into tech. Tech runs the world now, right? Tech companies are the biggest. They're doing the most numbers we've ever seen. They've reached profitability levels we've never seen in human history before. So, I think comparing things like tech stocks versus this, I just don't think it's in 2023 and in future years, like it just isn't a relevant conversation like it was 20 years ago, 30 years ago.
The XLE and energy stocks appreciating and moving higher. And this will mean that the Qs will take a leg back. And the higher the reinflation process in energy takes us, the lower the equities market will go. So all what we heard today in the media is, inflation is over. We're back to the threes. Next thing you know, we're going to go back to the twos. The job is done. The Fed should be backing off. But I've never heard anybody talks about the risk of reinflation. The fact that the dollar going down is good for reinflation, which will push energy commodities.
Mav must not watch enough CNBCs, because as somebody that has CNBC on several hours while I work every single day, I can tell you there's plenty of people that talk about like, inflation could make a comeback. It could be like the 70s. Dude, Mav, you got to watch more CNBC and you'd realize I think he has some sort of view of whatever his view is. But as somebody that, once again, I have CNBC on several hours a day, every day while I work. And I can tell you, especially over the past 9 months, they've had a lot more bears on than bulls until really like the past 1 to 2 months, because now things are flipped so bad that the bears are kind of giving up on their stances and kind of going into hibernation. Obviously the bulls are starting to kind of run the market, right? But different views.
And as a result, we will see a reinflation process in goods, not to mention, of course, the wage inflation problem that we have in this economy. Here's Mohammed Al-Arian once again.
2 is that the service sector is less sensitive to interest rate hikes. You need to do a lot more on interest rates to get to the service sector as opposed to the goods sector. And then the third issue is wages. We've got to keep an eye on wages. We don't want to fall into the trap of the UK, where the UK now has become an inflation process where wages are growing by 7%, with the private sector growing at 7.7%. And that's just a natural reaction to people's purchasing power having been eroded for so long. So keep an eye. Just let's not jump to conclusion. We've got to keep an open mind. The Fed has made many mistakes on inflation in the last few years, and one of them has been not to look at enough scenarios. And we've got to keep our mindset open to various scenarios.
And what are
100%. But let's be clear about this. If you're going to continue to see, let's call it high wage inflation, then that's going to mean essentially you've got extremely low unemployment. If you have extremely low unemployment, that means the economy is likely extremely strong. If the economy is extremely strong, that means earnings are likely going to be looking very good for companies, which means the stock market is going to be looking very good. So once again, man, all these things end up balancing out in the end, and you can't just look at it as a negative or just a positive. Like there's two sides to all these different things. If you want to say, okay, everybody's wages, go up quite substantially, Okay, cool. That's cool. Everybody gets to make a lot more money, but also guess what? They're going to have to pay a lot more money for everything. So the whole economy and the way you start to, dive more down the rabbit hole of how the economy works and this whole game, the more you realize for every positive, there's also a negative to go. And so if you're only pointing out the negative side of that, you're missing a whole other positive side of whatever you're talking about there, right?
The UAW is now formally.
You say, unemployment at 6-7% would be bad. Yeah, absolutely. That means massive amounts of people would be out of work, right? But that also means wage inflation would be like non-existent in that sort of scenario, right?
Beginning contract talks with the auto industry. In other words, if they don't get higher wages, they're going to strike. Yesterday, we talked about the prospects of reinflation in new car prices. Well, here's the evidence. The workers will be paid more, and they should. And companies will respond by raising prices for those new vehicles. And all of this is reinflation.
It happens all the time. All these unions are always, every few years come and do different deals and, get their workers more money and things like that. Like, there's nothing new. To act like this is just some phenomenon that is like now, it's ridiculous.
Popping the champagne because used cars prices went down, but it's only going down because new vehicle prices will go higher. Here's Alarian once again.
Bigger question, and that is what causes wage inflation? Is wage inflation a response to just rising inflationary pressures and the need for workers to be able to keep up with the cost of living, or is it vice versa? And I think, where do you stand on that? Because I think that's sort of key to understanding whether or not the Fed feels the need to knock the labor market down more.
You're absolutely right. And it is both. You can get to a phase where you are in the UK today, where inflation are both fueled and fueling higher wages. Fueling higher wages is easy. People are trying to protect their purchasing power. They ask for higher wage increases. And if they're in the service sector, they have pricing power. Fueling is the service providers feeling that they can pass through the higher wages into higher prices and therefore fuel inflation as a whole.
So all of the people who say that inflation is over, we have a soft landing coming, that's actually called mass delusion. We have not seen the end of this inflation episode. We have never seen inflation going down in one shot back to the target. Usually we have a process of reinflation. Usually we have a process of inflation perking up higher again. Usually the reason behind that is an error by the Fed policy. Pausing prematurely, declaring victory prematurely. But right now, the odds for a July hike is at 92%. So that's already in the bag. And they say because credibility. They paused, they said they're going to raise, now they have to raise. But that's it. That's the last one that they're going to do. Folks, we've been hearing this since November of last year. Oh, this is going to be the last one they're going to do. And they keep going and going and going. Why? Because they're not in charge. Inflation is. Now the odds say that in the September meeting, we're going to have yet another pause. The problem is, I just showed you, we're about to see goods reinflation because energy prices will move higher. Services inflation remains sticky. It never really went down in a significant way, and the base impacts are gone. The next reading could be absolutely shocking, and all of these hopes and dreams, the Fed...
Okay, so Matt makes a fair point, and then he makes a ridiculous point, okay? Makes a fair point about, expectations were, Fed was to stop, and then they kept going, keep going, but... yeah, we do know the Fed makes a lot of mistakes. And I think if they continue to push rates higher and higher and higher, it's a mistake in my opinion. And the longer they keep rates in a high place and the higher they go with these rates, the more a recession risk really comes into play. It absolutely catches up with you eventually. So I think, there's that factor. But let's listen to this.
Because they're not in charge. Inflation is. Now the odds say that in the September meeting, we're going to have yet another pause. The problem is, I just showed you, we're about to see goods reinflation because energy prices will move higher.
So if you want to see goods inflation, you can see that, but that's going to be because of essentially a situation where there's just so much demand for goods. That's why did we have goods inflation in the first place? Why did we have goods inflation in the first place? Supply chains were completely messed up, so there was lack of inventory for a lot of goods. The government pumped stimulus money out there like crazy. People couldn't spend that money on services, on going to a concert, going to the game and things like that. So people spent on goods like crazy. They were cooped up in their homes, right, during Rona. So during 2020, 2021, people bought a crazy amount of stuff from Amazon and just everywhere, right? So in order to get goods inflation to come back, you need an insane level of demand. Why is Amazon doing Amazon Prime Day right now, right? Or the last couple days? And why did every other retailer do a ton of discounting for all their different goods? Because clearly, goods is not super hot right now. Believe me, if all these retailers had such crazy demand and they felt great about their businesses and things like that, they wouldn't be doing any discounts, right? So these are just things to kind of factor in there about the whole, goods inflation, if you're going to see big goods inflation and things like that.
Inflation remains sticky. It never really went down in a significant way, and the base impacts are gone. The next reading could be absolutely shocking. And all of these hopes and dreams that the Fed will do one and done yet again.
That's a lot of bear talk, the next reading could be absolutely shocking. That's the way a lot of these bears talk. You go on Twitter and, they've been doing this for months and months and months. And get ready, the next one, you guys are screwed. The bulls are screwed. You're going to wake up to reality finally. And then they realize, oh, no, it wasn't that.
Watch out. They could do one, another one, another one, another one. Even go as high as 50 basis points. They're popping the champagne now, led by, of course, Mrs. Braindead, who used to be vice chair of the Fed, and she was known as Queen Transitory. Now she works in the Biden administration, and she came out today downplaying the chances of a recession hitting the U.S. economy and bragging about how inflation is lower than other nations. Will somebody pretty please remind her that rates are going higher? And they're staying higher for longer. And we're about to see reinflation in the economy, led by energy, services reinflation, goods reinflation, base impacts no longer here. And as rates continue to go higher and higher and higher for longer, what do you think will happen to this economy with the insane amount of debt? Look at this. We know that credit card debt among consumers is above $1 trillion. And the interest rate is now shooting to the highest level since the 1970s, close to 21%. So the dollar goes down, we see energy reinflation, yet the consumer, with these higher rates, will get choked even more. That's going to lead to a stagflation crisis in the economy. And some in the Fed already know that. Take, for example, from Minneapolis, Neil Kashkari. Today he came out and he floated the idea of a new high inflation stress test for banks. Not only that, but suggesting that regulators could force weakened banks to cut dividends to make them more sound. Now, if inflation is dead, if mission accomplished, why would we even bother with a high inflation stress test? They know the job is not over. They know that inflation will make a massive comeback. The second wave is coming, and it will be the most brutal wave.
So I think a lot of these folks should realize you've got to do a lot of different scenarios, right? If we know one thing over the past 4 years, right? If we've learned one thing over the past 4 years, things can come out of nowhere that you never expected to happen, and they happen, right? Rona, once in a 100-year pandemic, right? Obviously, Russia-Ukraine. Oh my gosh, we actually got a battle going on in Europe. First one since, what, WW2? That's crazy. Inflation, highest since the 70s. Oh my gosh, where did all this inflation come from, right? There's been so many things that have just happened and transpired over the past 3 or 4 years that I think all government officials have to think about all these different scenarios. And if you're not, you're just, you're doing your job wrong. Let's just call it that. I can tell you, if I was one of these government folks, you got to prep for all different sorts of scenarios, and dramatic ones too, because as we've seen, you're going to have a lot of dramatic scenarios come back, right?
Inflation episode. Not because it's going to be higher than last year's top at 9%, but because now the consumer is more indebted, because now the consumer is weaker. Now we have more systemic risk than before. And if rates will go higher in this country for longer, we've been ahead of a lot of nations. What do you think will happen to the UK and the EU? Well, look at the private sector debt to GDP ratios. They're sky high, above 100% across all of these nations. As rates go higher, it's going to cost more and more and more to service this debt, meaning less and less spending in the economy by governments, which will cause a recession. The other choice is to raise taxes significantly higher, which will cause a political backlash. The bottom line here, folks, is this is not over yet. We have more twists coming to this story. And the problem is the Fed misguided us by downgrading interest rate hikes from 75 to 50 to 25 and then a pause. And of course, everybody rolled with this assumption. We saw a recovery in the equities market, a recovery in the housing market. We saw the aggregate demand in the economy kicking in. And now we see wages moving higher again, beating expectations according to the latest payroll report. So we have more and more inflation coming in the pipeline. and today was the bottom in the CPI. From this point on, higher we go. And it'll be really interesting to see how the Fed is going to respond, how the equities market will respond, how the bond market will respond. Most importantly, what are the prospects of systemic risk event as interest rates continue to go higher for longer? With that, folks, this is all I got.
Yeah, so I appreciate, kind of hearing all his thoughts. Obviously, I think he made some good points there. I think he's grasping for straws on a few others, right? There's so many various factors that are to play out here. What continues to happen with CPI? Next month should be in the twos. We'll see what happens, but we should be in the twos next month, right? So, boom, all of a sudden we're basically in the range that the Fed wants us to be, right? We obviously need to continue to see PPI come down, core CPI come down. We need to continue to see those, right? That will give folks a lot more confidence that things are happening. Consumer sentiment has started to pick up. We reached the lowest level for Michigan consumer sentiment in the history of that survey. We reached that in 2022. It has started to pick up since that low of pretty much it was around last summer. So that's good news. We have some positive momentum going there, right? We got an election cycle that's about to come up. That's going to be crazy. That's all I know, okay? The presidential election cycle is going to be crazy. So there's so many factors at play here. What continues to happen in the economy? What happens with housing? I mean, to just say all bearish or all bullish right now, I think is a dangerous viewpoint, in my personal opinion. If you're full, everything's grand and we're perfect, I think you're making a mistake. If you're, full, bear like Maverick is, I think he's also making a mistake. I think both sides are making a mistake. I think it's going to be, moments that things look great, and I think there's going to be moments where people get really, really scared. And I think that's the way it's going to be for quite some time. And if you listen to a incredible investor who's got one of the best track records out there, Stanley Druckenmiller, right? What is his opinion? His opinion is, this entire decade, you might not even get returns in the indexes overall, right? So that is basically him saying that, you're going to have markets that shoot up and markets that shoot down. It's going to be a stock picker's market. And I think that's what I come to expect this entire decade, is this going to be a stock picker's market. And you have certain times when the indexes are flying, everything's looking great. And you're at certain time periods when the whole market's tanking and everything looks bad and people get scared about inflation coming again. Whether that's a reality or not, it doesn't really matter. That's enough to scare the market. If all of a sudden CPI starts to go up again month after month, then all of a sudden you see the market tanking more because they're like, oh my gosh, the Fed's going to have to remain high. They have to go higher in this game. So, that's kind of my perspective. So I always appreciate Mav's kind of viewpoints. Appreciate everybody. Much love as always. Thanks so much for being subscribed, folks. Also, if you want to check out the pinned comment down there, I just put together a stock picking checklist. It's 15 parts. And just put that together for you guys. It's absolutely free to access that. Put that together probably 2 nights ago. So that will be pinned comment down there. Much love and have a great day.